Everything I'm describing, we've been focusing on the U.S., but the U.S. is the world's largest economy, and the dollar is the world's largest payment currency and reserve currency, et cetera. So it's a good place to start. But we're looking at a global recession, and those are rare. As I said before, it's one thing if Germany has a recession or Japan or the U.S., but usually there's another economy or economic group that's doing okay or at least better and can kind of pull everybody out of the rut. But global recessions where everybody is declining are rare, and that's what's happening, and that's what we had in 2008. Pardon me. So the U.S. is heading for one. We've just talked about that at length. Japan's in a recession. Europe's in a recession. China's in a recession. India's having some tough times. And a lot of this is dollar related. All the other countries, I mentioned Switzerland, India, China, Japan have all seen their U.S. dollar reserves go down, and everyone's like, "Oh, they hate the dollar. They're dumping the dollar." No, it's the opposite. They don't have enough dollars, so they're selling treasuries to get dollars to bail out their own banks because there's a dollar shortage. So the fact that you see those dollar reserves coming down does not mean that they hate the dollar. It means that they need dollars, that they're short of dollars, and they're so desperate that they are selling treasury securities to get dollars to bail out their own banking systems. So we're well on the way to a global recession. And if you say, well, you got communism, socialism, capitalism, all these different economic systems, all part of this globalized system, how could they all be on the same wavelength at the same time? Well, the common thread is the dollar. It's the U.S. dollar. About 60% of global reserves, 80% of global payments. It's the benchmark for every other currency. So when you talk about the euro, you're quoting dollars. You're saying it's $1.05 or $1.04. Gold, you say, oh, it's $1,800 an ounce, whatever. The point being, even when you're talking about a commodity or currency that's not a dollar per se, you reference it in dollars. Same with oil, world market, it's all dollar oriented. So the dollar is the thread that runs through the whole global system. And it's a partial explanation for why everything's falling apart at once.
Makes sense. I know you only have a couple more minutes, so I would love to hear your thoughts on, asset allocation could be helpful for the folks watching and listening. What are you thinking about in terms of asset allocation for these more turbulent or uncertain times that you see ahead?
Sure. I'm going to say something that is going to sound so obvious that people will roll their eyes, but it's actually not obvious because very few people understand it. So the key in so we just talked about inflation, deflation, disinflation, global recession, some economies worse than others, supply chain breakdowns, so many, the war in Ukraine, so many variables that you can give different scenarios. You can, inflationary and deflationary scenarios. So how do you survive that? What's the optimal asset allocation method? Well, the key is diversification. And when you say diversification, people roll their eyes and go, oh, of course, everybody knows that. Diversification is good and all that. But the problem is they don't understand what diversification is. And I run into people all the time and they go, Jim, I'm highly diversified. I own 50 different stocks in 10 different sectors, telecommunications, semiconductors, mines and minerals, consumer non-durables. So I'm highly diversified. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which is stocks. And they're all going to go down together or go up together as the case may be. But particularly in times of stress, they become highly correlated. So having 50 different stocks or ETFs or whatever is not diversification. That's just having a whole bunch of bets in one asset class. So what does real diversification look like? Well, you should have some, 10-year treasury notes, or if they're a little too volatile for your taste, look at a 5-year note or a 2-year note. That will basically give you very the credit secure. I'm not doubting the credit of the United States, but that will give you a deflationary hedge. If we get into disinflation and deflation where interest rates are coming down, which I do expect, you're going to get very good capital gains on those notes, or you're going to be very happy with the coupon in the meantime. Real estate, definitely. Not so much commercial real estate, too soon for that, but multifamily housing, residential real estate, farms, other kinds of income producing real estate for a slice. Good slice of cash, maybe as much as 30%. People hate cash. They go, I don't get a yield on cash. Cash is a waste of my time, etc. It's true that it has very low yield, but number one, it performs very well in deflation, which we talked about. But more importantly, Cash is the opposite of leverage. It reduces the volatility of the rest of your portfolio. So if you have volatile investments in the wings, cash is it's like a bar connecting to two ends of the barbell. It has very low volatility, but most importantly, it gives you optionality. If you see stock markets crashing and burning the way I expect, the way I described, the person with cash can go out and go shopping in the ruins. And by the way, Berkshire Hathaway has over $130 billion in cash. Why does Buffett have so much cash? Well, he sees what I see. We're looking at the same thing, which is a kind of meltdown where the person with cash can basically go shopping for bargains. Definitely a slice of gold for the reasons we talked about. That'll be your inflation hedge. But 10%, people always say, Jim Rickards says sell everything and buy gold. I've never said that. I don't think that's a good idea. But 10%, yes. So that's a good slice. Private equity, if you can have access to good deals, that's a separate category. So a model portfolio, you'd have a slice of treasury notes, a slice of cash, has some stocks, but I would focus on, for example, energy, BP, Exxon, Mobil, Shell, Marathon, this Green New Scam thing, forget it. It's a big deal, from a policy point of view, but it's infeasible. I've studied the science very closely. It's going to go away. But in the meantime, if you bash the oil and natural gas companies, but you're going to need the oil and natural gas, which we do, then those stocks are going to do well. Real estate, I mentioned, and gold. So that would be a really diverse portfolio that would have 5 or 6 different asset classes. And some will outperform others. Some will do better in inflation, some will do better in disinflation. But that's the whole idea with this much uncertainty. And winners will outnumber your losers. And cash is like a thermostat. You can reduce cash and buy a little more gold, or reduce cash and buy a few more stocks if that's warranted. So that's what I think an ideal portfolio looks like. The Fed's on the path I described. My estimate is that they're already past the terminal rate. They don't know it. They don't think so, but they are. And as I said, inflation is going to come down a lot faster than anyone expects. But the markets are still factoring in soft landing. Like, rates come down, but the economy's strong and inflation cools off, and the Fed has to cut rates, and it's Goldilocks, and we all live happily ever after. I would say the market's wrong about that. They're right that the Fed's probably over tightening. They're right that the inflation is going to come down faster than a lot of people expect. And they're right that the Fed may have to cut sooner than the Fed expects. But it won't be that soon. It might be June 2023 at the earliest.